Hello. For this week, in Chapter 11, you are assigned 4 problems. The first problem is looking at explaining the difference between constant cost, increasing cost, and decreasing cost businesses. And we're looking at rate of return. This might be a new concept for some individuals, so we'll walk through this together. The question is going to say, a firm in a purely competitive industry has a typical cost structure. A normal rate of profit in the economy is 5%. So the firm is earning $15 on every $15 invested by its founders. What's the percentage rate of return? Well, we know the normal rate of return is equal to 5%. So we're asking, what is their current rate of return for the operation that they're using? Well, they're earning $15, okay, on an investment of $100. The way we calculate the rate of return is we have to divide how much they've earned by how much they invest. So the return on investment, or ROI, is equal to the amount returned. So we say earning is your return, divided by our investment, which is your investment here. We would say it's $15 divided by 100, which is, if we say our investment is 150. And therefore, our rate of return here is 115 divided by 150 would equal 0.1, which is equal to a 10% rate of return. So, is the firm earning an economic profit? Well, the way we say this is yes, the firm is earning an economic profit. How much is their economic profit? Well, the economic profit is equal to the difference between the actual percentage rate of return and the normal rate of return in the economy. This is the actual ROI, rate of return. This is the normal ROI. So what's the difference? Actual ROI is greater than normal ROI by 5%. So yes, the firm is earning an economic profit, and it's earning an economic profit of 5%. Now, will this industry see an entry or an exit? Well, this industry would see an entry, right? Because the rate of return is greater than the normal rate of return. Okay, because you have a rate of return greater than the normal rate of return, people are willing to go into the market to make more money, right? Economic profit is positive that resources could earn on average from other industries. So, in the long run, firms in this industry will earn the normal rate of profit 5%. This is when entry of new firms stops. So when the actual return on investment in an industry is equal to the normal rate of return, that's when we reach long-run equilibrium. So what would the rate of return earned by firms in this industry once the industry reaches long-run equilibrium? Well, long-run equilibrium is where the actual ROI is equal to the normal ROI. If we know our normal ROI is 5%, we would say the industry ROI, or the actual ROI, would also be 5%. And that's when it would be normalized. The next question is reviewing how long-run equilibrium and pure competition produces an efficient allocation of resources. The problem will read, a firm in a purely competitive industry is currently producing 1,200 units per day at a total cost of $700. If the firm produced 1,000 units per day, its total cost would be $450. If it produced 700 units per day, its total cost would be $425. So we can actually draw this a little bit. So let's write this down here. All right, so we have some quantity and we have some total cost. A quantity 1,200, total cost is 700. At quantity 1,000, total cost is 450. And at quantity 700, total cost is 425. So, what are the firm's average total cost at these three levels of production? Well, the average total cost, or ATC, is found by dividing total cost by the number of units. So average total cost, and that's equal to, again, dividing total cost divided by the number of units, or the quantity. For this first one, total cost is 700 divided by 1,200 is equal to 0.58, or 58 cents. For the next one, 450 divided by 1,000 is 45 cents. The last one, 425 divided by 700 is 61 cents. So, if every firm in this industry has the same cost structure, is the industry in long-run competitive equilibrium? Well, no. Right? Because the firm is producing 1,200 units, as stated in the question, this industry cannot be in long-run equilibrium because it is not producing at the lowest average total cost. Right? Long-run equilibrium means the firm is producing at the average low total cost. That lowest average total cost is happening here at 1,000 units. So if the firm was producing at 1,000 units, we could then say maybe the industry was in long-run equilibrium. From what you know about these firms' cost structures, right, what is the highest possible price per unit that could exist in the price market in long-run equilibrium? Well, again, right, the highest possible per price unit that could exist in the market price in long-run equilibrium, the highest possible price that could be supported in the long run is the lowest average total cost in the industry. Given the information from this question then, the lowest average total cost in this industry is again here at 45 cents, which would be the highest possible price that could be supported in the long run. So 45 cents. So if that price ends up being the market price, and the normal rate of profit is 10%, how large will each firm's accounting profit be? Okay, so in the long run, competitive firms will earn zero economic profit, right? Because their actual ROI will equal their normal ROI from the industry from elsewhere, and they'll be even. So they'll earn no economic profits, which is what we saw in the last question, right? They were earning an economic profit, so they were not operating in the long run. So again, in the long run, they'll earn zero economic profit. So their accounting profit will be equal to the normal profit. Okay, so if that ends up being the market, the normal rate of profit is 10%. So that would be their profit. And the firm will charge 45 cents for each unit in the long run. The accounting profit will then be equal to the normal rate of profit times the price. Okay, so accounting profit in the long run is simply going to be the normal rate of profit times the price. So in this case, the rate of profit is 0.10 or 10%, and the price here is 45 cents. So we get $4.50. That would be their accounting profit per unit. So the last problems are graphing questions. So for the questions, you'll see diagrams for both the industry and the representative firm, right, illustrating competitive long-run equilibrium. So assuming constant costs, right, given the change in demand, the diagram on the left shows how this affects the representative firm. So if you're given this diagram on the left here, you have some supply, you have a D1 and then a D2. They went from some quantity here to some quantity here, at some price point here to some price point here. How would that affect a representative firm? And you have some marginal cost here, and you have some, we'll say some average total cost. With the black line being marginal revenue. So we're looking at the relationships here, what's actually happening. So given the change in demand, right, the representative firm will produce more or less output at a higher price or a lower price. Well, looking at this first part here, we can effectively say that if demand changes from D1 to D2, quantity down here will shift to positive, and price on this axis will shift up as well. So given this change in demand, the representative firm, right, would produce more output at a higher price. The long-run equilibrium would then be talking about what happens with the shifting, and such a long-run market will, the industry price will then increase or decrease. Well, looking at the reference firm, what exactly happened? Well, we want our marginal revenue equal to marginal cost. Right, so long-run equilibrium will be supported by supply shifting out, such that the long-run market price will decrease. Because this is where we really need it to be. We want our price to decrease. So how to make our price decrease with the having to supply? Well, if supply comes over here, it shifts it out from S1 to new S2, you'll see from this point here to this point here, price decreases, which is what we want. Right? An increase in demand in the market will lead to a shortage, and thus an increase in market price. The representative firm, being a price taker, will react to this higher price, which also represents demand for the firm's product and the firm's marginal revenue curve by producing more. This output decision is based on price is equal to marginal revenue equal to marginal cost. Now, at this higher price, the firm, okay, is earning economic profits. This will act as a signal for other firms to enter this industry, right? As there are no barriers to entry in this purely competitive market. Now, as new firms enter this industry, supply increases, right? And supply also shifts outward, placing downward pressure on the market price. This process will continue until the market price is equal to the minimum average total cost of the representative firm. Right? We're actually would have happened like right around here, but this represents the long-run equilibrium for the industry and the firm, such that neither economic profits nor losses are being realized. So this last question is a discussion and a graphing about how long-run equilibrium and pure competition produces an efficient allocation of resources again. So suppose that a purely competitive firm producing cashews discovers that their marginal cost exceeds price. What's that really mean? So they're finding that their marginal cost is exceeding their price. Well, we don't want that to happen, right? We want our price equal marginal revenue equal marginal cost, or be greater than marginal cost. But in this instance, right, it means they're producing too much. They're producing too far along this marginal cost line so that their marginal cost is exceeding their marginal revenue. So what it means is that they need to produce less to get back to marginal revenue. Now, in the opposite, though, say their price is higher than their marginal cost, so they're producing over here, where their marginal revenue is exceeding their marginal cost. So you can see the difference between those lines there, the black line versus this blue line. Well, in that case, it means they're at some quantity here, right? They need to get to some quantity here. This is where they want to be, so they need to produce more. Again, if they're producing at some level over here, some Q2, they want to produce less. In the long run, though, what will happen to the supply of cashews and the price of cashews? Well, in the long run, right, if their profits exceed their marginal cost, it means that they're making an economic profit. If they're making an economic profit, other firms will get into the market, right? So supply will increase, and then the price of cashews will decrease to meet that lowest average total cost. Conversely, if marginal cost exceeds marginal revenue, right, suppliers will get out of the market because they're losing money. Now reduce supply. What happens when they reduce the supply? Marginal price, or the price goes up. So the marginal revenue will increase. So again, our marginal revenue will then be meeting where we are in the market.